you're talking about like a massive governance change. And for anybody who's followed what's going on with CalPERS or other large pension plans in the US, to make a change like that is unexpected, but also just impressive. SAA model is the board owns a lot of that decision making. Whereas in TPA, all of that gets delegated to the investment staff. There are some TPA firms that we've talked to who really have plenty of examples of making kind of bigger, shorter, medium term types of bets. I'll give one example of a firm we talked to where when rates got to zero, they said, why are we owning bonds with a 0% interest rate? So they literally took their bond portfolio to zero. From a SAA standpoint, you're like, oh boy, I've moved 3, 4, 5% away from my target. That's a big deal. For TPA, when we talk about being tactical, you're moving the needle.
I am joined today by Steve Novakovic, Managing Director of Educational Programs at CAIA. Thank you so much for joining me today, Steve.
Hey, Max, thanks for the invite. Really looking forward to the conversation today.
There's a bunch we're going to be talking about, but I wanted to jump right into the meat of it. Trillions and trillions of dollars of capital are controlled by institutional investors like endowments, pensions, sovereign wealth funds, and the decisions they make and the flows that those decisions drive have a tremendous impact on markets. And it feels like we are at a turning point in how those decisions are being made. I'm talking about the move from strategic asset allocation to the total portfolio approach. Am I feeling this correctly? How big is this shift and what does it mean for allocators, managers, and the rest of us?
Yeah, what a great starting question. CAIA certainly has been leading this conversation for the last year or two, and it really feels like over that time frame, it's been kind of a ball rolling down the hill, if you will, culminating recently with the CalPERS news of them switching over to that model. Now, part of your question is does this mean we should start seeing a cascading effect of more allocators going into that? That'll be interesting to come out, but I think there is a lot there. And I'm not saying this because of the research that CAIA is doing. I actually say this as a former allocator. I used to work at an endowment in the US that was under the SA model. And that is a entrenched model that has been around for decades. And to change is a big deal, right? These are like slow moving ships. And take CalPERS as a good example here. You're talking about like a massive governance change. And and for anybody who's sort of followed what's going on with CalPERS or other large pension plans in the US, to make a change like that is unexpected, but also just impressive because you just wouldn't expect their governance and leaders and so forth to like make that dive. And so that's huge. And I think that them doing that almost, I don't know, gives permission, if that's the right word, to all these other organizations to start thinking about doing that and looking at what their models are like and if there's a model that might be more appropriate for them. So no, I think it's big for sure.
So they're the first pension. Who else were sort of the first movers in using TPA? And can you talk about how the governance changes from strategic asset
Yeah.
allocation, which I think people are relatively familiar with?
They're really the first movers in the US, at least of size, brand name, whatever you want to call it. TPA has been around for almost 2 decades at this point and really emanated from two geographies. One would be Oceania, Australia, New Zealand, and then the other one would be in Canada. And one of the things that's really interesting about its origins and roots is that many of the early adopters that we know today, like the Australian Future Fund, or even in Canada, CPP, part of their reason that they were able to kind of make that change or even look at that change was where they were in their life cycle when it started. So in the case of Australian Future Fund, literally that fund launched day one as TPA. So it wasn't that they had a legacy system that they had to switch over to. With CPP, there was a lot of change going on organizationally where it wasn't as complicated, if you will, to kind of like come in and be disruptive in that way. And so for some of the earlier adopters, there was a little bit of either fresh piece of paper, if you will, or external disruptions that were already happening, that this wasn't sort of introducing something new from a disruptive standpoint. So now for some of the newer adopters to kind of come in and change course in the midst of kind of a regular course of business, that's really what's exciting and very different. But yeah, the big names, the big adopters early on really came out of Australia, New Zealand, and Canada, and more recently, then we've also seen a pickup in other parts of Asia as well.
So, what is the actual change being made in benchmarking, how allocation decisions are being made in the overall portfolio construction? What is the shift?
The biggest ones, I think they're the most tangible that people can identify with, is that particularly here in the US, the traditional model is you've got a board that is very engaged and takes that fiduciary responsibility very, very seriously, to the degree that they own a lot of the decision making. And so owning the decision making can come in a couple different forms. It can be um, almost universally under the SAA model, decision making at the board level will be, we will just dictate or approve, whatever the right word is, what the asset allocation looks like. So you're going to have 10% here and 30% there. And that is a board level approval decision. Often it's in conjunction with the investment team working on it, but sometimes the board will hire consultants to do that. But then also there are models where the board has to approve every investment, or maybe every investment above a certain size, meaning that, again, like, authority is not delegated to the investment team. They're like, they're going out and doing the research, and they're spending months, figuring out if this is a great manager. And then they go to the board and do a 10-minute presentation. The board can say, nah, no thanks, you know, and that's kind of that's the traditional SAA model, is the board owns a lot of that decision making. Whereas in TPA, all of that gets delegated to the investment staff. The investment staff decides what the asset allocation is going to look like. They decide what managers or investments to make. And the thing that the board owns, which is true in any model, is they own kind of what the overall objective is for the portfolio, meaning like a return objective or a risk liability objective, whatever the case may be. And so it sounds like a small change, but it's, again, it's letting, as a board, it's letting go of a lot of authority, if that's the right word, and putting a lot of trust and faith into the investment staff that you've hired, and not micromanaging, not approving every single decision, and really letting them lead the decision-making process. That's, I'd say, the biggest number one impact, period, end of story, that you see in terms of contrasting the two. There's other stuff I'm happy to talk about as well, but I want to start and stop with that first big one.
Now, what about the benchmarks? Because I know strategic asset allocation, one of the hallmarks of it were that each asset class was sort of had its own benchmark. So if your allocation consultant or your board came down and said, we want 20% in private equity and we want this amount of it to be LBO versus venture capital or whatever, there would be a benchmark for each of those buckets. Maybe private equity as a whole would have its own benchmark, but even in some cases, those specific sub strategies might even have their own benchmark. How does the benchmarking change and as the name suggests, a total portfolio
Yeah.
approach start to come into play?
That type of benchmarking of, like, I want to see how my private equity investments did relative to a private equity benchmark, that doesn't necessarily change sort of at the internal level. The investment team may very well find that to be an important and useful exercise. The CIO may believe that that's a really good way to evaluate the quality of their staff. Um, but ideally, under the TPA model, those types of analysis are not really front and center in front of the board to any degree of regularity. And instead, the board is thinking at a very big picture about a benchmark. So some examples that you'll see from TPA folks is their benchmark might be just 70-30 stocks and bonds. And then that doesn't mean that the portfolio has to then be 70% stocks and 30% public bonds, but that the underlying risk profile might be consistent with 70-30, or that the performance that you ultimately are held accountable to needs to stand up relative to the outcome of a 70-30 portfolio. But that the board's not going to then go and look and see, oh, okay, I see that you allocated 10% to real estate. Let's see how your real estate did against, a real estate benchmark. It's just going to be, here's your portfolio return. We told you that you ultimately have to achieve a 70-30 outcome. Let's see how you did in that regard. And that's kind of at the TPA level, that's what a benchmark's going to look like. It's going to be not granular. It could be an absolute return number. It could be liability driven in the case of a pension plan. It could just be, a stock bond combo. But internally, there's still definitely going to be like an interest and desire to understand how your allocation decisions and security selection, but the board will should no longer be pain going into those weeds. Yeah.
So as you said, this change from CalPERS, let's use them as the example. You say this change was not necessarily surprising, but not to be expected when you think about just how the governance at these organizations works. My head naturally goes to something happened. What happened? What is the environment of the last 5 years or so? Maybe it's further along than that, that is causing this shift to happen at this moment in time.
Yeah. I'm going to butcher it a little bit, and I hope that I'm not being offensive to CalPERS or even mischaracterizing it, but I guess I'll say it. Is that there's a phrase I really like, which is you make a change when the pain of changing is no longer as great as the pain of staying the same. And if you look at the history of CalPERS, I mean, you can go back and see how many CIOs they've had in the last number of years or so forth, or the performance that they've generated and how it compares to maybe some of their peers and so forth. And my hunch is, I have no inside information here, so I don't, I'm not trying to suggest I do, but my hunch is that there finally was enough introspection after X amount of time that we've got to do something different. You've been spinning your wheels for the last decade, 2 decades, and going through CIOs, going through performance, underperformance, whatever the case may be, that you finally, that the pain of making the change was finally worth it. And they brought in a CIO who came from a TPA model. So we shouldn't have been surprised that it was likely for him to then recommend that outcome. But I think that's in the CalPERS case, I think that's probably a big part of the background and motivation was that there was just like, we can't keep banging our head against the wall. I think for other organizations that might ultimately move in that direction, it very might well be just more of an evolution than like a step function. One of the things that we kind of started talking about in our research and work that we're doing on TPA is that there's different called gradations, if you will, of TPA, and it's not just one or the other. There's a spectrum, and I wouldn't be surprised if in the next couple of years we see more and more allocators just sort of moving along that spectrum from SAA towards TPA, but not necessarily going all the way to one end of the spectrum or completely abandoning some of the stuff of SAA. But in the case of CalPERS, it definitely feels like it was a pretty kind of step function type of an announcement.
We've all heard about the
Mm,
rise of private
mm.
credit, the slowdown in distributions from private equity, and is the ability to react to those types of environmental impacts limited by SAA? And did factors like that, do you think, influence this decision?
And we're not in the room, so hard to say specifically. But to your point, one of the appeals or benefits, if you will, of TPA is that, especially if and when you're delegating authority to the investment staff, you can be more quick moving, more reactive. You don't have to wait until the next board meeting to make some suggestion or so forth. And then similarly, not to suggest that TPA is defined by short termism by any means, but I would say that there's more openness or willingness or ability to be opportunistic, perhaps, from a TPA standpoint. My own lived experience within SAA was if something was an investment opportunity that was less than, let's call it 12 months, maybe 18 months, we would just sort of go and say, hey, we're long-term investors, and that's not really us. Whereas TPA is more willing and interested in say, oh, here's a 6-month thing that could be pretty interesting. Let's lean into it. Or here's a 12-month opportunity. And to your comment, like the post-COVID environment certainly has felt a little bit more volatile, a little bit more kind of one where, you could benefit from kind of being nuanced in your decision-making, but also nimble in your decision-making. So it could be the case that some of the board members felt like it could be a value add for them to unleash the team to be able to be more responsive and reactive to the market rather than, waiting every 3 months for a board meeting or whatever the case may be to talk about something.
Yeah, and what does a tactical, more short-term opportunity look like for an allocator? For an individual investor, might be like, "Hey, there's a Dutch tender on, like,
Yeah.
this stock I
Yeah.
own, and, like, I can make some free beer money, by playing this thing." Like, obviously,
Yeah.
that's not what's happening
Yeah.
at an allocator level. What is a short-term tactical opportunity that an allocator would see?
Yeah. And let's be clear too, like there's no, and this is something that's like, there's no firm like TPA rule here, right? So there are some TPA firms that we've talked to who really have plenty of examples of making kind of bigger, shorter, medium term types of bets. And then there's others where it wouldn't feel the same way. So like, I'll give one example of a firm we talked to where when rates got to zero, they made a decision to basically neutralize their exposure to fixed income. They said, why are we owning bonds with a 0% interest rate? So they literally took their bond portfolio to zero. Now they did that synthetically. So they used derivatives to offset that. But that's like a crazy decision to all of a sudden be an allocator that normally had a 20% allocation to fixed income and take it to zero for like a 1 or 2 year stretch. But the thing I would point out though is like under the traditional SAA model, allocators would say, oh, we are tactical. We make tactical asset allocation decisions. And that is true, but I want to kind of compare what that means versus TPA. And specifically, like when within the framework of SAA, when you talk about tactical asset allocation, usually what that means is you set your target, but you've got bands. And it might be our target is 20% private equity, but we're allowed to float between like 15 and 25. And so tactical asset allocation might be, oh, now seems like a great time to be in private equity. Let's allow the weight to go to 22% or 23%. From a SAA standpoint, you're like, oh boy, I've moved 3, 4, 5% away from my target. That's a big deal. For TPA, when we talk about being tactical or when we talk about making shorter term decisions from a bet standpoint, I'm talking about like, oh, you're moving the needle. Like you're going from 20 to zero. You're going from 10 to 30. Not all those decisions have to be those big decisions, but I don't think you're finding too many SAA investors that make that dramatic of a change to the profile of their portfolio for a 6, 12, 18 month stretch. And really it's sort of the fat pitches, if you will, which don't come that often. So when you talk to the TPA folks and you talk about that opportunism, it might be once or twice a year. I'm not talking about it being a regular thing, but it's a once or twice a year decision that an SAA investor wouldn't make or couldn't make. And it can be very impactful.
Now, we've been talking a lot about the allocator side. I'm sure the managers in the audience are hearing this and saying, hey, that personal relationship I've made with the analyst in charge of hedge funds or private equity, that certainly sounds more important than it did a year ago or 2 years ago if the allocator is switching to a TPA. Should managers be excited about this change, and how should they be approaching interactions with allocators to deal with these shifts?
It completely changes the conversation. So going back to the SAA model, it was pretty straightforward usually to understand where new money was going to be invested. You look at your target weights, you look at your actual weights and go, oh, we're slightly underweight hedge funds right now. I guess I have to go invest in hedge funds. And you literally go out to the hedge fund universe and say, I've got a mandate to invest in hedge funds right now. And it would be each hedge fund would be sort of competing against each other to fill in that slot that needed to be filled. Under the TPA model, you're not a hedge fund competing against another hedge fund. You're competing against the rest of the universe for that allocation. TPA doesn't necessarily say, I need to have X% in private debt, or I need to have Y% in real estate. And so it is a very much kind of a best ideas mentality. And so that the person who oversees real estate at TPA may get really excited about a real estate opportunity, but then when they go to their internal committee meeting to talk about what's on the opportunity set, they might hear a pitch from their private debt person and go, oh, that sounds way better than this real estate thing I'm looking at. Let's go in that direction. And so GPs need to understand that they're not competing against like strategies, number one. So what that means is, number two, when you're a GP, really the conversation comes down to what is it that you're looking for? How can we support what you're doing in your portfolio? So sometimes the TPA conversation might be, we're kind of concerned about inflation right now. So we're looking for strategies that we think can be beneficial in that environment. And it might be that it's a real estate strategy. It might be that it's a floating rate debt strategy. Who knows? And so the conversations might be a little bit more thematic with the LP or sort of objective based or needs based. And the LP is not concerned about what bucket they're using to meet that objective or accomplish the outcome. They're just looking for the best vehicle, the best investment that can support whatever it is they're looking at the moment. And so that's what GPs need to think about and have that conversation, that proactive conversation with the LP of what is it that you're needing and how can I then kind of match that need and have that conversation with you about the products that I have that can support whatever outcomes you're going for at the moment.
Do you think that that is beneficial for any particular subset of GP types? Like when you're looking at private equity versus private credit, are there some firms that maybe were hurt by the rigidity of SAA that might see greater flows in a TPA world?
I kind of hate to say this, but to a certain degree, you'd almost wonder if it would sort of benefit the larger GPs who offer different strategies within their platform, because you can develop a relationship with one of them and it's like, okay, great. Yeah, maybe your private debt fund right now isn't meeting a need that we're looking for, but I know you've got 6 other products that you offer. We can, one of those might have a fit for us. I mean, clearly the ones that might be most challenged in the TPA model are firms that are very much single product and maybe even a bit niche in that single product. Cause it's like, if that product is sort of meeting one kind of solution type of a thing, and that's not a solution that the LP is looking for, then it's just, you have that one conversation and that's it. It's like, great. Now we know that you do this. And when the time comes that you do this, we'll have that conversation. But, in the meantime, there's nothing to talk about. So, um, I think if you're a GP who's got multiple products, multiple strategies, you might feel like you're drooling a little bit more because you feel like you've got to have something on the menu to offer them, versus those single product ones where it can be a pretty quick conversation of it's obvious that this isn't something that's going to be, part of what you're looking for at the moment.
So, what are people hunting for on the menu right now?
The environment's definitely been kind of evolving in the last year. We've kind of gone from like a rising high rate market to now what seems like a declining rate market. So that has certainly started to change the narrative a little bit around private debt. Um, the, the economy is doing okay, but people still have a lot of this uncertainty on the geopolitical side and what's going on with tariffs. So, kind of from what I've been hearing on the ground is there is maybe a little bit more of a defensive bend than there has been in the past. So it's probably those are going to be maybe more of the conversations that people are going to be interested in hearing is what do you offer that gives me that confidence around liquidity, because if you're uncertain, you want to make sure you can kind of make portfolio changes. Where do you, how resilient is your strategy to stress that might be forthcoming? So I think those are kind of some of the conversations we might be hearing LPs looking to have in the next couple of months is those types of strategies that might be playing a little bit more defense than offense.
We did see cracks in one particular strategy for the first time since it has exploded onto the scene in private credit. Some people arguing that the cockroaches aren't in my house, they're in your house. We definitely
Yeah.
saw some throwing of that line back and forth between senior executives in the private credit or syndicated loan world. How similar those are is not really for me to say. Um, how are allocators thinking about private credit after they've really been feasting, but we have seen cracks for the first time?
I think it's pretty popular to sort of talk about the narrative of concerns around private credit. But I think when you look at people's books, I don't know that it's changing too much. And I think folks are still allocating to that space. I think there's room for that strategy to grow in lots of allocations. There was an acceleration of like, oh, my historical target was 0. I want it to be 10. But I don't know that everybody necessarily got to that target. So I still expect money to be committed there. I think the last couple of years, there was just sort of lots of checks being written to just about anybody. Now it might be that there's more diligence or prudence around who you're writing the checks to, but I don't expect that the check writing to stop. Um, the bigger conversations now is just simply like, okay, hey, we might actually enter a credit cycle. We've seen a couple of defaults now. So hopefully, I forgot you could lose money in credit. And so who are the managers that maybe have been around through a credit cycle? There's a lot of first time private credit funds that launched either post COVID or certainly post GFC that don't have a historical track record for you to evaluate to see how they can handle distress in their portfolio. So I think that managers who have a longer history and can point to the work that they've done to navigate through credit cycles have a distinct advantage right now. Or managers who over the last couple of years were disciplined and maybe didn't just put every single dollar to work as quickly as possible and, showed that they still invested in loans that had covenants or, had nicer spreads than because they, weren't just sort of bidding to the lowest IRR. So I think that's kind of what you're going to start to see is just more discerning decision making from LPs. But I don't think that the private debt the music has stopped by any means.
What about private equity? Obviously, the big topic for the last few years has been distributions, and really the lack thereof. It definitely differs from fund to fund and vintage to vintage, but it has been something that people have been concerned with on the LP side. Has there been any light at the end of the tunnel for the slowdown in distributions?
Yeah. So, I mean, look, PitchBook just came out with some stats on this, and there was an uptick in distributions in 2025. Not a massive uptick, certainly not like what we saw in 2021 when it seemed like every single venture backed company went public for that year. But maybe the news was better than the headlines would make you think. Now, that being said, the one thing we have to be aware of is how much of that was driven by stuff like continuation funds. Because the other thing a stat I think I saw from PitchBook was that I think it was about 25% of liquidity events this last year was through continuation funds. And in that case, if you're an LP and you're sticking with that continuation fund, it's not actually liquidity. It's just left pocket, right pocket in terms of where it's, what fund it's sitting in. So that's kind of a false statistic there in that regard. But needless to say, the headline on actual liquidity events was slightly improvement in 25 relative to the previous years. And there is just like every year, there's optimism coming into this year on the IPO market. We've heard some big companies talk about their intention to go public this year. And what we know from the past is if those couple of big ones do come out and have success, that could open up the spigot, you know. But if those big ones either decide to delay or they come out and don't have as strong of a showing as they hope, then that's going to be pretty problematic, I think, from an IPO standpoint. So that's something I think we all will be excited to watch. But there's a decent chance that this year ends up being a pretty good year for new IPOs.
Do you think that this headline, this turnaround in 2025 is enough to change the perception? And I think there might be two perceptions. The perception we have as the readers of headlines and the perception with the actual LPs that you get to speak with. So I guess how different is the perception from the outside versus the conversation you're having with insiders?
Well, the other thing to keep in mind too around the tune is that there's two kind of things that you're thinking about when you're a limited partner is, am I getting distributions when I think I should be getting them? You make an investment in a private equity fund, you're not going to get a distribution in year one or year two, right? Like we know how it works. But by the time it gets to year 4, 5, 6, you're starting to expect some degree of liquidity. So there's sort of that conversation as to like, is this fund getting to the point where you're like, hey, you're 6, 7 years into and I haven't seen a dollar yet. That's a very legitimate conversation. But then the other thing that can drive that conversation could be, there can be funds that are giving distributions in year 6, but I know we've all kind of heard and seen headlines around the denominator effect. As long as the public markets are continuing to do what they're doing with, 10, 15, 20% returns per year, and if private equity is also similarly having, huge returns along with that, and they're not giving enough distributions to sort of offset that like NAV growth, your issue becomes like, oh gosh, I'm over allocated. And this is a SAA problem in a lot of ways, more so than a TPA problem. But like, it's like the GPs need to over distribute to keep the weight where the LPs want it to be, right? So they might be distributing at what they feel like is an appropriate cycle. But if their NAV growth continues to be so healthy because, public markets are doing well or so forth, and the underlying values going up, they're not like giving back enough money to LPs that they continue to have this I'm overweight issue, which is a little bit more of an LP problem, but might be contributing to that whole headline of we need liquidity. We need you to give us money back because without that, we're overweight and we can't make new investments. And everyone wants to make new investments,
We talked about continuation vehicles a lot. I mean, there are new entrants into the world of private markets and alternatives, and that's private wealth, and mom and pop are starting to get in there. Is that going to be the big driver? And are we really going to see distributions purely come from IPOs to the public market, or do you think continuation vehicles, secondary markets are going to be a bigger part of liquidity and distributions for LPs moving forward? And that's not
Yeah.
changing.
One thing that we need to keep in mind though is a company goes public, but it still is going to be a while before you actually see distributions from that. Venture capital firm, first of all, they've got lockups. Venture
Yep.
capital firms do, but then secondly, they may very much, with valid reasoning, wish to hold on to that stock for maybe 2 years before they decide it's time to sell and exit. So, they can go public. There might be a little bit of liquidity potentially from a secondary, if any shares are sold from a secondary standpoint at the IPO. But it's sort of funny that we can be like, oh, great, there's an IPO, I'm going to get my money. It's like, you might not actually get it for another year or two, depending. So to that point though, like what's really cool now is two things. One, LPs have more control, if that's the right word, over liquidity to a certain degree in their portfolios. We've seen a rise of secondary markets. It's no longer kind of like a novel thing or like a hold for only for some people type of a thing. If you're an LP, like part of your liquidity decision process is using the secondary markets. So if you feel like you're not getting enough distributions or you feel like you need to rebalance your portfolio, there's no stigma around it. There's no challenges around accessing it. Depending on what you're selling, you can still get pretty reasonable marks for those sales. So I think that that's something that's here to stay, and we can probably will continue to see for a while here is LPs sort of taking more ownership or control, if you will, of their liquidity by using the secondary market. To go to your point specifically about the retail investors, what's probably exciting for LPs is that that's new money that needs to get put to work. And so you're seeing evergreen funds come out or other types of funds come out that are catering to the retail investors. They might, those funds might go and find new deals that aren't already private equity backed, but certainly low hanging fruit would be to go and be an exit for a fund that's holding on to a company. So if I'm a retail investor, one thing that I'm mindful of is it's very possible that my money is buying a deal that's, been trapped in a portfolio for the last 8 years. And that can be a really great deal, or it could be that, who knows? But I do think that the retail money could be a welcome source of capital to help create exits on the GP side.
We saw some headlines this year. I believe it was Harvard, maybe a couple of other endowments did go into the secondary market for some of their private equity stakes. I believe that the discount was around 15% to the marks. Certainly, depending upon what side of the aisle you were on, some people were saying, oh, this is the endowments are giving up on private equity and they're blasting for the door. And then other people said, no, this is just standard type of stuff. How did you view those headlines, and do you think 15% is the benchmark right now for what you're gonna get if you want liquidity?
The answer sort of depends on what you're selling, but we have really good statistics around sort of what the average price is, depending if it's a buyout portfolio versus a venture portfolio versus real estate. If you told me that a LP was selling a diversified portfolio of buyout investments, I would, in today's market, I would say that, a discount of kind of 5 to 10% would feel like kind of the equilibrium, if you will. And so if they sold something and it was a buyout portfolio and they sold it like a 15% discount, I would be like, oh, that seems like they maybe kind of, lost a little bit out on that unless they were really selling some dregs of their portfolio, if you will. Whereas if it was like a venture portfolio, everyone knows if you're selling venture, not because venture is bad, it's just there's even less liquidity there and there's, higher risk that you're going to take a different discount. So I'd have to look at the exact composition of what they were selling. But I would say if you're just talking about middle of the fairway buyout portfolios that are 4 or 6 years old, probably like if you're selling for a 5, 8, 10% discount, that feels like it's a reasonable price. And I'm as a observer of this, I wouldn't say that like that's a bad outcome. Um, don't forget it's an opportunity cost. What are you doing with that money now that you're getting it, right? You might be able to go reinvest it in something that you think is going to even do better than what it was sitting in the first place and can well overcome that 10% discount. The other thing to keep in mind too, part of that discount is sort of the prepaying for fees that are going to come, right? Like if I just hand over that portfolio to someone else, if there's no change in underlying NAV, you're paying fees on it for the next couple of years. So the buyers usually have to pay a little bit less so they don't sort of lose on the fee component to it. So there is sort of like embedded costs. That's the right word. Anytime you're buying a portfolio. So it is natural to expect there to be a little bit of a discount, which has nothing to do with the assets, but more to just do with the expenses associated with it. So, um, at the end of the day, Harvard and those other ones, the way they'll prove if it was a good outcome is what they do with the money that they freed up. If they take that liquidity and make some investments that then kind of generate, 15% IRRs, 20% IRRs, they'll come out ahead and it was a good deal for them. But that's the
Yeah.
question.
Who then is the buyer? Who's stepping in to take that 5 to 8% discounted stake? Is it other LPs who have already been in the market? Are these sort of middle tier LPs who don't get access to the same
Yeah.
quality of funds? Or maybe they didn't have access to the same vintages because they weren't in alts 10 years ago or
Yeah.
whatever it is. Who is stepping in and is interested in buying these stakes on the secondary market?
Yeah, there's lots of different good reasons, some of which you already, mentioned. So one good reason would be I'm newer to the strategy and asset class. I know it's important for me to be diversified by vintage year. One of the best ways to do that is through buying a secondary portfolio because now you can step in and not all of your money is sort of lumped into one brand new vintage and you can get NAV into the ground right away. If I go and take $10 million and I give it and that's my allocation to private equity, and I give it to a fund manager, it's going to take 5 years for that to get drawn down. But if I put a portion of that into a secondary purchase, immediately I now have NAV in the ground for that allocation. So anyone who's sort of starting from zero or near zero, a secondary allocation can be really useful to get money into the ground and get that vintage diversification, which we all talk about as being very, very important to not have all your eggs in one basket from a time standpoint. So there's a really good reason on that side. The other one that you mentioned, which I would also very much affirm, is it's a good way to get your foot into the door to certain relationships that might be closed to you otherwise. Once you become an owner of that stake, you now are an LP with that GP, and you can start being more formal in your relationship with them, and maybe that allows you to develop enough of a relationship that in future fundraising you can get that ticket with them that you wanted to have, or a larger size than you had before if you already were in the door, but not in a meaningful way. So those are two really, really good, reasons. And then the last one is if you look at the historical return profile for secondaries, I can't deny the fact that the IRRs specifically, not the multiples, the IRRs on secondary investing are very robust. So if you're somebody who's IRR focused in your returns, it could be a really great strategy for you to sort of meet that kind of benchmark, if you will, and put some great IRR numbers up in your portfolio, because that is something that secondaries have a robust history of succeeding in terms of creating or in cynically manipulating high IRRs.
Are there some sharkier LPs out there who are like, yeah, we'll wait. We'll wait 5 years. There'll be somebody who wants to get out and we'll buy their stake at a discount, get the same assets, and we're happy to wait.
You-
And it'll be shorter time to get our
yeah.
money back.
One thing you have to keep in mind with an LP, for the most part, the second you make that decision to sell on the secondary market, you're probably ending that relationship with that GP. So, if it's a GP you want to be with long term and you're just like, hey, I want this liquidity, but I'll see you for the next fund. I don't want to guarantee that the GP is going to be really excited about letting you in the door the next time around. So, and I mean, in all sincerity, again, putting my LP hat on, you hope that when you find that GP that you're partners with them for the rest of, for the next 20, 30 years. You're not, LPs aren't in the business of churning a portfolio and finding new GPs over and over and over again. You really want to make sure, you really hope that you put all this time and investment into a really long-term relationship. So really, you're only doing that LP secondary sale when you know that you're unlikely to renew that relationship with the GP anytime soon, because it's a pretty big decision that is likely to sort of uh, end that relationship for, if not permanently, for a while.
Yeah, that's interesting. My question was more about the other side, which would be the
Hmm.
LP who says, "I'm gonna pass on putting
Oh,
money in on day 1 because I
hmm.
know that there is going to be a market for this down the line." And is it allowing LPs to actually wait and see how you deploy the capital, whereas in prior cycles, you had to be there on day 1?
It's a good question. The one thing to keep in mind is, like, it's competitive, right? So, um, it is possible that you could still get in at a discount. That's true. But you're not going to be the only one bidding on the asset, and it's most likely going to go to the highest bidder. So if you're prepared to be the highest bidder, that's fine. And by the way, really high quality GPs that are brand name GPs, there can be times in the cycle where on the secondary market, their funds trade above NAV. I've been in that situation where we've been able to sort of execute that or see that happen in the marketplace. So, that's something to keep in mind as well, that it's not always the case that things trade at a discount. So, mm, I would say if you have the opportunity as an LP to get into a really attractive GP that is kind of hard to get into, you're probably going to jump at it, period in the story, and not try to kind of be, slick about it in terms of waiting and seeing if it comes up on the secondary market. But to your point, like maybe for the more kind of generic names that are out there, you might say, hey, sure, I'm sure, you know, big asset manager fund X will be on the secondary market in 5 years from now. I can get into it then. But you just have to keep in mind that if you're going to win that bid, you're paying the highest price. And that doesn't always mean that you got a deal.
So when I think about the secondary market, there's the ability to buy stakes directly between LPs. So Harvard sells their stake. There's the continuation vehicle where maybe the assets get moved to a new continuation fund. And then there are these secondary funds, which they're going around and trying to buy things on the secondary market and create maybe a more diversified portfolio of secondaries. You mentioned being able to get in the secondary market as an opportunity to develop a relationship with a GP. I guess that's really only the case if you become the actual owner. What about these other funds out there that are separate from the original GP?
So the continuation vehicle is definitely one that could work in your favor as an LP. This isn't universal for every single continuation fund, but there certainly are continuation funds that are being offered to non-existing LPs. So you could, because not every single existing LP will say yes to the continuation vehicle, and maybe not every existing one that is saying yes will want to go above their pro rata. So there might be allocation left over, and the GPs will fill that by bringing in new outside LPs. So no question, absolutely, you as an LP can be opportunistic in that way and make your first kind of relationship with that GP be through one of their continuation vehicles, and then let that be your kind of entry into future fund investments. To your point, if you go with sort of one of the standard secondary fund managers, that's probably a little bit harder of a way to build those relationships with the underlying GP, depending on who that secondary fund manager is. If they're maybe smaller and nicher, they might be willing to be open and working with you to make introductions. Maybe if you are trying to partner with that secondary fund manager around offering co-investment dollars or other kind of things that they can do that's a little bit more bespoke with you, that gets you to kind of have a more direct relationship with the GP. But I would say it's probably the harder avenue. You'd have to be more creative with those secondary fund managers to kind of have them intermediate that introduction, and make you be more of the face of the dollars rather than that secondary fund manager. But continuation funds, absolutely, that could be another great way to get directly to that GP.
I want to switch to slightly more liquid alternatives and hedge funds. It's the end of the year or beginning of the year, and that means we're getting performance numbers. And certainly in years like we had in 2025, where equity markets have performed well on the back of multiple years of equity markets performing well, people love to compare hedge funds to the S&P 500, and you start to see that commentary. Well, why would anybody invest in these vehicles when this is what I did in my PA, which was, 50% NVIDIA or something like that.
Yeah.
And so that it's a perennial conversation that happens when hedge fund returns come out, especially in up years. And I always think it's just helpful to get the LP perspective. You've been in that seat and specifically looked at hedge funds. What is attractive about hedge funds to LPs?
In theory, the hedge funds should be an area that would be able to take advantage of some of the greatest sort of alpha creation opportunities, if you will, dispersion in markets, the issues with fundamentals across different companies. So you can kind of go long and short and take advantage of those dislocations that might exist and so forth. Um, but when you have beta driven markets, dispersion's low, everyone's fundamentals are on. So, you're not getting that. Or the ones that are like overpriced just continue to be overpriced and become more overpriced, whatever the case may be. And so, one of the things that's been really challenging for hedge funds over the last decade plus is that much more of the returns in the market have been driven by beta than alpha. And then the way the model is set up for hedge funds in terms of how they're compensated is, you're paying them 2 and 20 on the returns. And then you're looking at the returns about, I'm paying you 20% on a lot of beta. And as an LP, that's not something that you're like, well, if I'm just going to get a bunch of beta, no, and not necessarily the fault of the hedge fund, just more the underlying environment. You're like, well, I should just go long only then. And so what the market really needs from what the hedge fund market really needs is to see some of the elements that are conducive to creating more alpha opportunities to kind of reappear, for beta to not be the dominant driver, if you will, not just continue to have equity markets go up 15, 20+% per year, or whatever, actually have dispersion, actually have, opportunities where you can generate returns on both sides of your book. But until that happens, I think that there's going to continue to just sort of be a lack of love for hedge funds, frustrations about the performance that they're generating. I'll quickly just mention, like you mentioned, kind of the year-end review. I was just looking at hedge fund benchmarks recently to see how they finished the year, and I'm sure that hedge fund advocates will point out to, hey, look at equity long short. It was up 10, 12%, or even some strategies are even more than that. It's like, okay, yeah, well, that was driven by the beta, right? The S&P was up, whatever, 17 plus. And if you, to your point, were in a bunch of growth stocks and NVIDIA, that's what drove your portfolio. It wasn't like you got of that 12% return. It wasn't like 8% of it was the alpha that you generated. It was predominantly beta. And most sophisticated LPs can kind of go through and look and disaggregate how those returns were generated and go, oh, okay, well, it looks like you just sort of had exposure to markets and that's what drove your return. And now I'm paying you 20% incentive fee for you having beta exposure. And so I think that's the real kind of issue that needs to be figured out here. And markets need to be more available from an alpha standpoint for hedge funds to really shine.
Yeah. On the long only front, it's interesting because I think we've all seen the studies that show that mutual funds, public equity funds in general, on the whole, underperform their benchmarks. And yet there is 28 trillion in active management in mutual funds and ETFs. And I'm citing a study from Goldman that came out looking at 5-year returns ending in 2024. And they looked at hedge fund long only products and they found 200 to 300 basis points of outperformance in a group that has 600 billion in assets under management. So I just have to wonder, And I'm sure many of those managers after fees got paid for beta. Like there was beta they got paid for. Is there just a philosophical resistance to paying for beta, even if the net result is better? Right? Like, yes, the manager did get overcompensated for the beta in the portfolio, but the net result is still better. Why? Why does it matter that this person is getting rich?
So when I started in the industry, when we evaluated um, hedge funds that were more equity oriented, we knew they had beta, like that wasn't like a question, that was part of the model. But our attitude was that even if they have 50% of the beta to the market, that over the long term, 3, 5 years, their returns should be the same as the market. So half the beta, but they have so much alpha that even after 2 and 20, they're meeting the market return. And then the real appeal is that they're doing so with so much less volatility. So your downside risk in theory is lower, your volatility is lower, your Sharpe ratio for people who are really excited about Sharpe ratios is through the roof in that regard. And to be frank, and so this is like 2005, that was realistic. It was something that equity oriented hedge funds had done up until that point. But you haven't really seen that be accomplished often since then, partly because of how much beta there's been. Like if, the equity market's up 20%, you're capturing 10 of it. Like good luck getting 10% of alpha after fees. Like that's crazy. Um, but so, but also I think that there's been, the hedge fund market from 2005 to today is, gone from what, a trillion some odd dollars to 4+ trillion, $5 trillion. And there are some strategies that are scalable to a certain degree, like equity long short, but like, merger arb, convert arb, whatever, like there's so many deals out there. You can't just like, and so spreads have narrowed for sure in some of the more niche strategies. So the amount of alpha that exists in some of those strategies, especially when markets aren't dislocated, is a lot smaller. So I think there's just sort of been, kind of a perfect storm of asset growth, compression spreads, big beta rallies that have made it so there's just less alpha. It's just sort of on a year-to-year basis for hedge funds to go capture in certain markets. And then to your point, like the big ones that are now 30, 50, $100 billion hedge funds, the headline that you see is that you just made that manager of a billionaire off of the 2% management fee and the 20% interest or incentive fee that you're paying them for the beta that they're producing. And for a lot of LPs, that just is kind of like, that's not what I'm signing up for.
I'm talking about the funds where it's like, yes, it has a beta, it has 100% beta, right?
Yeah.
And the market did 20, and after fees, they did 25,
Yeah. Yeah.
right? And they consistently over
Mm,
full equity market cycles
yeah.
outperform, but yet, I mean, clearly active management in mutual funds is still being allocated to,
Yeah.
and
Yeah.
increasingly ETFs are being offered. Like they're still getting them, and yeah, the fee is lower. It's 60 basis points or less, or, maybe it's 100 basis points. But on the whole, like they're still underperforming. Is it just that these other long only hedge fund
Mm.
products don't scale, or is there just a reticence to pay for that, even if there is proven outperformance?
I'll admit, like the one thing that always confused me is that um, people couldn't look past the difference between the gross and the net returns. Like my attitude was, if I'm getting a great net return, that do I feel a little bit sick about the fees I'm paying to get there? Maybe, but at the end of the day, the net return is what I earn. And for whatever reason, there are some people who just, um, I don't know if it's a principle thing or what, but like, if you don't mind me stepping over into the venture capital world for a moment, like, you know, some venture capital funds are 3 and 30, right? That's insane. But then those fund managers might get a 5x net return. Where else are you going to get a 5x net return? But then if you're like, well, what would that return have been if I wasn't paying 3 and 30? It could have been like 6, 7, whatever X. And you're giving up quite a bit. But yeah, people aren't complaining as much about that because they're getting like a 5x out of that investment. And so to go back to your analogy of like, markets are doing 20 and I did 25 on a net basis. I feel like the best thing to do is go and say, okay, well, that's good. 25 is better than 20. But I don't know why. I can't explain it. But there's just a cohort of people who just get sick to their stomach to be like, but look at all the fees I had to pay for that.
Yeah, it's funny too because there is a cohort of managers in the public equity world that love to talk about, like, their marketing rule requirements that say you
Yeah.
have to talk about your net return if you talk about
Yeah.
your growth, but they
Yeah.
believe, and people have written about this, that the gross return is the true measure of skill, and so
Yeah.
they're obsessed with talking about their skill. I'm like, "You're telling people how much they're giving away in fees, like,
Yeah.
you don't have to market your gross return, you only have to give people net, and in fact, it's what matters most, and by showing that you did gross, 1,000% since inception and your LPs have received 700, you're telling them how much they've paid you in fees, and it can be a nauseating number for people despite how
Yeah.
good that net return might be.
Yeah. I always, to your point, I always found it silly when a manager would talk to me about their gross returns because they're like, I don't care. That's not what I'm getting. Like, and you can pat yourself on the back for that number, but I don't get to see it. I know you do in your own book because you're not paying yourself fees. It's really funny. I have a friend who works in the hedge fund industry and I'll like catch up with him like, oh, how's the year going so far? And he's like, oh, I'm up 10. I'm like, oh yeah. Is that gross? He's like, yeah. I'm like, okay, so you're actually up 7 or whatever,
Yep.
and he's like, oh yeah, I guess so. But and so what I'm trying to get at with that is I don't think that the average sort of GP looks at performance on a net basis that regularly. Certainly the people who are sitting in front of the Bloomberg terminals and looking at their own P&L, they're not even, it's not even in their mind that like their number is less than what it is because, it's something else that someone else has to deal with. But it is very true that as an LP, like it could be nauseating to kind of see the difference between the gross and the net, and also to have a GP tell you about how amazing they are because of their gross return. And you're like, I don't care. That's not what I get. And your fees take away all of that alpha that you're talking about. You know,
I wanna move a little bit more towards education and the role that you and CAIA specifically are playing. We talked about the growth of the private wealth capital in the alternative space, and certainly, I imagine that that is the group that needs to be educated the most when you think about, there's certainly new entrants into alts from the endowment, sovereign wealth fund world, but the resources they have, everything, I imagine private wealth is where a lot of that is going.
as an individual investor, I'm excited about the opportunity that, my portfolio can be open up to more investment options. So I always will be an advocate of making more available. But then the thing that gives me the greatest fear is people who invest in things that they don't know anything about. That's the easiest way to lose money, right? Is to kind of invest in something that you're not familiar with. And so that's where sort of the intersection lies is like, A, you want to be supportive of the democratization, if you will. But then B, you want to make sure that people are doing it for investing in those because it has a appropriate role in their portfolio. It has the right fit. They're doing it for the right reasons. It's et cetera, et cetera. And so, what we are doing is giving some of that base knowledge to investors who aren't familiar with what private credit is, what real estate is, what private equity is, how to put it in their portfolio, what role it plays in the portfolio, what you can expect from it. I think a very easy, tangible example right now is we've already sort of talked about these evergreen funds. It's like, oh, cool, I could have private equity and liquidity. Okay, maybe, probably like for a little bit, but not always. And suddenly, like, there's some dislocation in the market, and an investor goes, "All right, great, I'm going to sell my evergreen private equity fund, get my money back." No, that's not going to happen, right? And they go, "Whoa, what happened?" It's like, oh, because you know what, like private equity actually isn't liquid, and you can't just like sell a company like that. And these evergreen funds aren't going to necessarily be able to give everyone their money back when they're all coming to the door at the same time. And so, sort of those types of conversations that need to be had to like truly inform people of what they're getting into, what the risks are, what to be aware of, what role it can play in the portfolio, and what to kind of keep your eyes open for. And we've already alluded to some of those things. Our evergreen fund is the marginal buyer of private equity deals right now. What does that mean in terms of the types of deals they're getting? Does that mean you actually kind of that this is a good time to be in those funds, or are you kind of getting cast offs? Evergreen funds may say they're liquid and you can get your money every quarter, but the reality of it is there will be a time where you won't get your money in a quarter because it just won't be available, so on and so forth. So being able to really kind of inform the private wealth world, the retail investor, on kind of what those strategies are, how they fit in the portfolio, why it would make sense for you to have it in your portfolio versus not, and some of the things to keep your eyes open to. Very important.
What are the other things that you think newer investors to the alternative space should be paying attention to? If you're used to looking at a mutual fund or an ETF performance page or prospectus and you get the 1, 3, 5 year return that everybody has to present, it's very different in the alternative space. And you can
Yeah.
even mean very similar offerings get extremely different marketing materials and statistics based off of what they believe is important or representative. How should investors be dealing with that variability and newness?
Yeah, I mean, there's a couple things. I mean, number one, how you measure performance is different in private markets. The common term is IRR. We've been using the term IRR throughout this conversation. But IRR doesn't exactly perfectly translate to time weighted returns. So you might say, hey, the S&P was up 15% this year. And then you'd say this fund had an IRR of 13%. That's not an exactly apples to apples comparison to use. And I would say the average investor probably doesn't understand how IRR is created as a number, and what that exactly means and how it can be manipulated, for a lack of a better term. So that's number one. But then number two, also benchmarking to a certain degree. Again, like, um, I'm not saying that it's unfair to say benchmark private debt to the S&P, but if you're going to evaluate the success of an individual investment, you might want to compare it to what its, universe is. And so in that case, like, all right, great. I went into this private debt evergreen fund. How do I know if it did well or not? What am I comparing it to? Because I probably shouldn't just compare it to the S&P. That's not exactly like kind of its universe. So I don't know that. So that's something that people probably have to kind of figure out and understand. Because you can say, oh, I invested in Nvidia and it did better than the S&P. That is fair and apt, but like maybe not for some of these evergreen things. And then the last thing is, this is something that I think evergreen funds do well as a solution, is that they can, because of the way they're structured and the evergreen nature of it, they will be time diversified. But for some of the bigger investors who may not just use evergreen funds, but go into funds them directly themselves, you can't just say, oh, I invested in this one private equity fund. That's it. I'm done. I have my exposure. You have to be time diversified. And I think that's a really difficult thing for people to understand. Growing into the allocation as opposed to going from 0 to 10. You can't go from 0 to 10 overnight. Secondaries is part of a solution for that. But then you've kind of got that ongoing commitment as well, where you're going to kind of have to regularly commit the money to keep that allocation. And that's something that it's very foreign to people, because in the public markets, it's okay, great. I want to be in this stock. You can put all your money into it in one fell swoop in one day and have it there. And there's your allocation. But private markets, there's a lot of work that goes into managing the size of the commitment, the pacing of the commitment, the time diversification. Evergreen funds are a really awesome solution for that. But for people who are looking outside of evergreen funds, there's a lot of work and expertise that goes into that.
So what about resources and educational materials that you have through CAIA for people who do want to learn more about alts and add this type of stuff to their portfolios or their clients' portfolios?
We welcome anyone who's interested. And for the most part, a lot of our sort of informal material is available to the broader universe. We've got podcasts and blogs and webinars that anybody can go to and learn about these topics. And then we have more formal certificate and micro-credential learning programs that are online, self-guided, 5, 6 hours of watching tutorials and training videos on stuff and so forth. So it kind of depends on how deep and technical you want to get and how sort of formal in the learning you want to be. But but for folks who are interested in, like, for example, learning about private equity, we've got a 7-hour micro-credential program that you can pay for to really learn about private equity. But if you're interested in just sort of getting a little bit more of a conversation around what the heck secondaries funds are, we've got a 2-hour podcast that talks about secondaries and what's happening in the market and why investors might choose to use a secondary fund or not, or so forth. So, we tried to make our material sort of available to everybody and inclusive. And then it just sort of comes down to how deep of a learning experience you want, how formal of a learning experience you want in that regard.
Yeah, going all the way up to getting your CAIA designation and being a chartered alternative investment analyst.
Yes, and I sort of gloss over that one because that's the 200+ hour time commitment that a select few make that decision on. I don't know that a lot of retail investors are going to say to themselves, I want to go get my CAIA charter before I, invest into an evergreen fund. But that is also available for sure. And a lot of folks who work in the institutional alts world um, pursue the CAIA charter and getting a CAIA designation. But on the retail private wealth side, those certificates, micro credentials, and other learning experiences really kind of fit that profile quite well.
Yeah, and that is, the CAIA NXT program. We do actually have a special offer for everybody listening today, that if you go to the link in the description, we have a 10% off coupon. It's coupon code MM10 that you can get to get, 10% off on any of those micro-credential programs, and we have, private debt, private assets or digital assets, real estate, private equity, and, I'm sure there is more to come in 2026. What is next coming down the pike for CAIA NXT and some of the other programs you have?
Yeah. The one that is coming out now is called portfolio implementation. And so a lot of it's what we've been talking about today. Hey, I now kind of understand that I want private equity in my portfolio. I want real estate in my portfolio. How do I do it? How do I think about how much to allocate, where the allocation comes from, the time diversification stuff. So that portfolio implementation micro credential is a 9 hour long one filled with a bunch of expert interviews where we're bringing in industry practitioners to sort of talk about how they actually do this, what the practices that they do, and so forth. So really excited about how kind of practical and industry oriented that one is. And then what else you'll expect from us in 2026 is we're doing a micro credential on TPA for people who are interested in getting more on that. We're going to do a micro credential on infrastructure, which complements well kind of the real estate, private equity, private debt ones that we've already done. And then this is something that we're really excited about because we're a global organization and we're seeing a lot of interest outside of the US, of course, in terms of adoption of alts and access to alts. And so we're doing a micro credential later this year that's targeting around Islamic finance and its application in the world of alternative investments. There's a lot of growth happening in the Middle East. Islamic finance is also relevant in parts of APAC, Malaysia, Indonesia, so forth. And so not everyone listening to this will necessarily find that to be relevant for them. But from our standpoint, we're tapping into a universe that is a rich universe in terms of people and interest in education that we really feel like can benefit from understanding that connection.
Very cool. Well, thank you so much for joining me today, Steve. It was a lot of fun. And again, reminder to everybody, if you are interested, go to the link in the description, learn a little bit more about CAIA NXT, learn a little bit more about alternatives, and take advantage of that special offer.
Well, Max, thanks so much for having me on. It was a great conversation. I really appreciated it.
Oh, it's my pleasure, Steve.